This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Hello, and we're going to go through now and have a look at the computer-based exam from the ACCA website on financial reporting. And this is the group account question from the sample questions that were given from the September/December 2019 exam. Okay, so it's the second of the longer form questions that were contained within this exam. So as with all of these questions, I think the first thing to do is to go through and read the requirements first. Pretty straightforward in terms of the requirement for part A, nothing unusual there. Prepare the consolidated statement of financial position. So we know that we're looking at assets, liabilities and equity. For runner co, so runner must be the parent within this arrangement, and you've got a year-end date, is it the 31st of March 20x5, okay? And you can see there that it's 16 marks, so you'll need 8 marks to pass that part of the question. You can work out how long you should have available for that part of the question. Now, what a lot of people will do within the exam is they will go through and attempt part A first. Why? Because it just wants you to prepare. It wants you to crunch the numbers. And the problem is that when you crunch the numbers, you just get carried away with crunching the numbers to the point whereby you see that there's a part B, you see that it is only there for 4 marks, and what you do is you neglect it. When personally, I think what you should be doing is you should be looking at part B first, answering that, because then that will then free up more time for you to go through there and answer the remaining parts of part A. So make sure in a question like this, if you can do part B first. So let's have a look at part B. So it says here, explain. So it's wanting some narrative explanation how Walker should be accounted for in the consolidated statement of financial position of Runnerco. So again, Runnerco is the parent. Walker, we'll see who Walker is in a moment. Again, for the year ended, is it the March 20x6? Your answer should include a calculation. So not only are we explaining things, we're calculating some numbers of the carrying amount of the investment in the associate. So it's giving it away how things are going to be accounted for. It must be an associate whereby we have significant influence at that date, the 31st of March 20x6. Okay, and if you think about the 4 marks that are available, I'd have thought that there's 2 equally splits between the explanation and the calculation. So there'll be some relatively straightforward numbers, reasonably straightforward explanation. There's not a huge amount that you can say about associates. It's only a small part of the syllabus, but one here they can get you 2, 3 or 4 pretty straightforward marks. So what have we got? It says Runnerco acquired 30% of Walker Co's equity shares on the 1st of April 20x5. Okay, so we have 30% of the equity shares. Anywhere between 20 and 50%, doesn't it? Gives us what we refer to as significant influence, because you have the power to participate. Because you have the power to participate with that 30% ownership, you are going to equity account. You do not control it because you don't own greater than 50%. So therefore you do not consolidate it. You will equity account for it. Okay. You know, as you read on, Walker had been performing poorly over the last years. Runner hoped that its influence over Walker, so again backing up significant influence, would help turn the company around. And the year ended March 20x6, Walker made a loss. So when we're looking at the investment, we'll be looking at our share of those losses. And it says Runner has no contractual obligation to make good the losses. So we're just going to take our share and not effectively all of those losses. And I think if we did have the contractual obligation to make good the losses, I think that would more be a strategic business reporting, SBR type question, as opposed to an FR financial reporting question. So here we go, nice and straightforward. You know, make it clear to the marker that you're starting off with part B. Okay, so you can put that there right at the very top. And then all I go through and say there is that runner is to equity account for its investment in Walker. And you think, why? Because, if I can spell properly, because it owns 30% of the equity, which gives it significant influence. Okay, excellent. There we go. You just can't see what I've gone on to write there, but that's no great issue. And again, we can't spell, but there's no big particular worries there. Okay, significant influence. Okay, perfect. So we've said the reason why, because it gives it significant influence. If you like, you could put in the words power to participate. And then what I go on to do is explain about the equity accounting. So to equity account for the investment, runner would show an investment in associates in its non-current assets on the statement of financial position. It would show its share of profits / losses on the statement of profit or loss immediately before profit before tax. Okay, excellent. And I would expect us to get, if you like, the full marks available in terms of the 2 for that item there. Okay, I'll then go on to put in the calculations. The calculations, I think, just wanted it on the SFP, didn't it? Your answer should include a calculation of the carrying amount of the investment in the associate at that date. So here we look at the cost. So again, we're going to go through there and work in thousands. So the cost was at 13 million. So that's there at 13,000. To which we then go and adjust, don't we? Is it for our share of the loss? So here is that 30% multiplied by the loss, which here was it 30 million. Just be ever so careful there, because the loss is then deducted. So 13,000 less than 9,000, the 9,000 being 30% of the 30. So does that give me there our investment in the associates? Okay, the investment that you have there in that associate is there at 4,000, and that is what will then sit, won't it, on the statement of financial position. Nice and straightforward there. So that goes through and deals with part B. I get that done first because that shouldn't take all that long within the exam. It's pretty factual. There's not too much involved in the calculations. So what I'll do is I think I'll stop this video there. So you've got the answer to part B. And then what you can do is you can then watch the next video, which we'll go through there and have a look at part A. Okay, so welcome back. We've gone through and done part B, haven't we? Which you're going to promise me that within the exam, you are going to attempt Part B first. Because if you've attempted Part A first, you're not going to do so well. Yeah, you're going to miss out on those 4 easy marks. Myself and those who are listening have hopefully done Part B first. We've got 2, 3 or 4 marks and we've saved ourselves a little bit of time as well. Okay, that's Part B shouldn't take too long to answer. Let's focus on this video on Part A, the preparation of the group or consolidated statement of financial position for runner as the parent at the 31st of March 20x5. And the important bit to understand is the group structure. And a lot of the group structure you can always go through and effectively find at the beginning of the question for a group SFP. So what you've got is information. It says on the 1st of April 20x4. So given that we have a year end of March x5, April x4 is the start of the financial year, isn't it? And it says runner acquired 80% of jogger. So we know runner, we knew it already that runner was the parent. So jogger must be the subsidiary. Now it then goes on to tell us lots more information about everything at the acquisition date, something to do with the retained earnings at 19.5 million. It tells us a lot about the consideration, which just looks scary because it gives me a discount rate and that starts making you think about financial management. So let's just ignore that for the time being and start thinking about what else is within the information. So you've got your bog standard statement of financial position or your assets at the top. You've got your equity and liabilities at the bottom. So again, if you're trying to get the easy marks, we're just going to add across 100% of P. We'll add across 100% of S. We'll also go through and put in 100% of the parent share capital only. So there will be some easy marks available there. And then you've got some additional information. Not huge amounts of additional information, but what you can see there is that in part 1, it tells me about valuing the non-controlling interest. So that's going to be important in terms of our Goodwill and NCI calculations. It also tells me as well something about the fair value of the assets and liabilities. So that's going to help you within your net assets working. We're then told a little bit in the second bit of information about a sale of goods from jogger to runner. So is that the jogger being the subsidiary selling goods to runner? Still has some of them in inventory, so I'm thinking that there must be some provision for unrealized profit. And then it starts talking about invoices, payments between the parent and subsidiary. So you're thinking about some intra-company balances, some intra-company transactions that are happening there. Okay, so what I would do is I would start off, I'd go with part A, and I would look at the group statement of financial position at the 31st of March 20x5. I'm going to start off with my assets. I will start off with my non-current assets, and I will start off there with my property, plant and equipment. And what I'll do underneath is I'll put in a bracketed working 45800 plus 44700, just taking 100% of P and 100% of S. I'll finish that calculation off a little bit later. There then is your investment. So again, we're going to eliminate any investment that the parent has in the subsidiary, and then any remaining investments are investments outside the group. So shall we leave them in place? Don't forget, you've then got your goodwill. So I'll reference that to my workings, which I'll do later. I then have my current assets. So is that going to be inventory? So again, easy marks there, 22,000 plus 16,000. Receivables. Receivables there, 35300 plus 9,000. So I'm just adding across 100% of P, 100% of S. Nothing too difficult. And then on the bank, 2,800 plus 1,500. Okay, excellent. And that will then give me my total assets a bit later on. Equity and liability. So you're going to start off there with the equity section. You've got your equity shares. So again, it's just 100% of the parent only. So is that there? 202,500. So give yourself a few columns, tab it over, and then just put it in a separate column there. Nice and straightforward. Don't forget, you've then got your retained earnings. So again, I'll reference that through to a working. You've then also got your non-controlling interest as a separate working. And then all you've got, isn't it, I think if we have a look, your current liabilities. So there's not a lot happening there at this moment in time. Current liabilities. Current liabilities 81,800 plus 17,600. Oh, what did I touch there? Okay, must have touched some key on my keyboard. What you probably noticed there is I have just cut, paste. There we go. Yeah, I missed out, didn't I? Payables, trade payables. So just right click, cut and paste. There we go. And then what we can go through and do at the end, we can work out our total equity and liabilities. There we go. Excellent. All good. So nice and straightforward so far. Okay. Nothing too taxing just yet. Again, as you're working through, you're going through the financial statements individually. So we've nearly crossed off all of the various bits and pieces in relation to the parent and the subsidiaries accounts. What I would do there, however, is I would then set up my net assets working. So I've got my net assets working. So remember what we're looking at there is we're looking at the year end. We're looking at acquisition. And then we're looking at post acquisition. So 3 columns there. And then don't forget what we're looking at. Your equity shares. So I'll just widen that column ever so slightly. My equity shares, what are they? So in the subsidiary, the net asset to the sub, they are 25,000, aren't they? That's at year end, and they will never ever change. So that will be what they were at acquisition. Retained earnings of the subsidiary at year end, they're 28,600. We don't know just yet what they are at the date of acquisition, do we? But what we can then go through to do is we've crossed off all of the assets, crossed off all the non-current, current ones, all the payables, all of the equity of the parent. Just be careful, there's one that's missing. 286,600, that of the parent only. Okay, so it's up to you how you progress. What you can do is you can set up some pro formas as you go along. So Goodwill, boom, boom, boom. What have we got there? Let's underline that. Leave yourself a little bit of space. You've got NCI. So again, leave yourself a little bit more space. Group retained earnings, 100% of P, and what we've got there, how much was that? Let me have a 286,600. There we go. Excellent. That just means that you don't forget that figure, doesn't it? Okay, you need to scroll up quite a bit. I've left quite a bit of space. doesn't matter. The examiner is going to see it. It's going to work right the way through your script. Okay, excellent. Everybody happy with where we are so far? Hopefully that shouldn't have caused you too many issues. Okay. What I would do is I'd start looking at the net assets and the information that you've got at the top. So it says there the retained earnings at acquisition were 19.5 million. So I can put that in. That should be pretty straightforward, shouldn't it? Okay, 19,500. It then goes on to tell me a bit about goodwill. It says the consideration consisted of $42.5 million paid on the 1st of April X4. So that's a nice easy start, isn't it? To what you've got for your goodwill. So you've got your cash consideration of 42,500. There we go. It goes on to tell me about a future cash payment. So I'm like, yeah, there's going to be some deferred cash. I'm like, thanks, but no thanks. Okay, we will leave that for the time being. Okay. But let's just note, it does say within the question, no accounting entries have been made in respect of the deferred cash payment. So that must then mean, mustn't it, that an entry has been made for the 42.5 million. So what that then means is that we need to eliminate that investment that the parent has within the subsidiary. So I've got 55,000 less the 42,500, and that will go through there and give me the amount that I need for my investment. Okay, we can finish that off afterwards if you so wish. Which column have I put all the numbers in? E. So I shall put that in now. That gives you there, is it 12,500? Okay. Everybody happy with that? Yeah, we go through there, deal with the investments within our goodwill calculation. Once we've dealt with that investment, we can then go through and remove that investment from the parent's books. Again, lots of space underneath in terms of my goodwill, but I'm moving on. I'm trying to get the easy marks first. And again, what you should then be able to go through and see is if you look at the first bit of additional information, it tells you that the fair value of the non-controlling interest is there at $13 million. So within my goodwill calculation, I'm putting in the 13 million. Should get you a pretty easy half a mark, I'd have thought. And then my NCI acquisition is also then that 13,000, isn't it? Okay. Excellent. Any questions? Feel free to post them on the discussion board. Okay. Yeah, the OpenTuition forum. We're doing pretty well. Yeah, let's move on. What we told is we're then told the fair value of Jogger's other assets, liabilities, and contingent liabilities at April X4 were equal to the carrying amounts, apart from some specialised plans which had a fair value of $10 million in excess of its carrying amount. Okay, this plant had a 10-year remaining use. Forget that. Let's deal with the 10 million excess. Okay, let's get that first, because what that is saying is that we have a fair value adjustment, which was there at 10,000 at the acquisition date, and it will be 10,000 at the reporting year-end date as well, won't it? Don't get carried away. Be careful. You've increased the net assets of the subsidiary in the group account by the 10 million. So don't forget, therefore, then to make sure that you scroll up and within your property, plant and equipment calculation, you then add in the 10,000. Okay, again, a lot of people tend to miss that out within the exam. You can then deal with the fact that this plant had a remaining useful life of 10 years on that acquisition date. Why? Because what you then need to do is you then need to depreciate that fair value adjustment. 10 million over 10 years is there as, what's that, 1 million per annum. Okay, excellent. There we go. Good. Again, just be careful. Let's scroll back up. You do get used to it all ultimately. Moving backwards and forwards, all the way up and down. But much easier than pen and paper, and away you go. Okay, you've got your property, plant and equipment. I don't think there are any further adjustments to do with my PPE. So that gives me 509,500 if you then wanted to go through and add everything across. Okay, excellent. You could put it all into a fancy formula and get the spreadsheet to do it for you. You just then risk hiding the formulae and then having the issue that if you make a mistake, the marker can't see where you've gone wrong, and then all sorts of problems then occur. Okay. The good thing is, though, is that if you look at the information that you've got in part 1 of the question, we've pretty much dealt with it all, haven't we? Okay. We've dealt with part 1 to do with the NCI. We've dealt with part 1 to do with the fair value uplift of 10 million and the additional depreciation too. Wasn't too bad, was it? If I was to look at this question now, I'd be pretty confident that we've gone through there and passed it. Okay. Everything else that happens in part 2 is all about December X4, something that has happened towards the end of the year at March X5. So everything about the acquisition date is now okay. That we don't need to do anything else. Anything else now is all to do with the post-acquisition period. Okay. No, I can't insert a line, but we have enough space. So if I go through there and total up my net asset to acquisition, I'd hope that you'd be getting this right, because there's just a fair value adjustment and nothing else. Okay, so you got 5,500. So what I can do, I can then put my 5,500 in to my goodwill calculation. There's no mention of any impairment. So what I would be able to do shortly is, once I've got my deferred cash figure for goodwill, I could then work out my goodwill and we would then have it all done. Okay. Bits and pieces that were missing, net or non-controlling interest. So I'll need to put my non-controlling interest share of the post-acquisition profits. Similarly, I'd need to put in the group share of the post-acquisition profits in our group retained earnings calculation. But before I do that, I need to finish off part 2, because surprisingly, part 2 goes through that and has a little bit of cheeky information that impacts our net assets working. What have we got? Well, it says December X4, so during the year, Jogger, who's the sub, so S, sold goods to Runner for 6.4 million. A gross margin of 15%, and they held 4.8 million of these in inventory at March X5. So what we've got is we have a PUP adjustment, and just note it's S to P, isn't it? The sub to the parent. So we're going to adjust S's retained earnings, and we see S's retained earnings in the net assets calculation. The sales that were in inventory at the reporting date were the 4,800. As a percentage, was it a 15% margin? Yes. So you've got 100, 85, 15. So the profit that you've got there is going to be equal, is it to 15% times 4,800. Okay, does that go through there and work out at 720? Should we just double check? So what we've got, 0.15 times by 4,800 is 720. There we go. So you have a PUP, a provision for unrealized profit of 720. S sold it to P. So we're going to have to go through there and adjust. Is it there? S's retained earnings at the year end. Move that 45500 down. And don't forget as well, this is the common mistake that people make, is that don't forget you debit the retained earnings of the seller and credit your inventory. Okay, so you have to reduce the inventory, a credit to inventory by 720. If you tap that on your calculator, it should give you 37280. Okay, excellent. There's some other funky stuff going on in part 2 about some intracompany balances, but they're just adjustments that impact the face of the statement of financial position. So what I would be tempted to do now is to work out the total net assets at year end in your net assets working. So again, you can use your calculator, or you can go through there and sum it up if you so wish. So you've got 61880. Your post-acquisition figure is then 7380, isn't it? Okay. I still need to work that deferred cash. I've got a little reminder and a mental note to do so. But what you've got there is you then, within working for your non-controlling interest, apologies, we own 80%. So therefore, we have, is it 20% multiplied by the 7380. If you tap that on your calculator, it gives you 1476. So what do we end up with there? Is that 14476 for your non-controlling interest. And then in the group retained earnings, 80% of 7380. Does that give me 5904? Okay. Again, let's just have a quick check. Can't read my own writing on my notes. 80% of 7380 equals 5904. Excellent. Brilliant. Okay. More than passed the question. Done really well. But there's bits that we're missing, aren't there? So we need to play around with those. And it's up to you what you deal with first. Do you deal with the deferred cash payment, or do you deal with the outstanding balances? It's up to you. Okay. Just because I've highlighted them, I will use them first. So we need to scroll back up to the face of the statement of financial position. What have we got? Okay, so let's look at receivables and bank. It says Jogger had the full invoice value of 6.4 million in its trade receivables. So I think we're going to have to remove that, aren't we? Okay, so within receivables, we're going to have to remove the 6,400. However, runners payables only showed 3.4 million. So we're going to have to remove the payable at the 3.4 million. And then it says, is it made a payment of 3 million on the 31st of March? So we're going to have to record the bank. Is it there with the 3 million? Okay, excellent. There we go. Just notes. I'm sort of loath to do it, but I will do. Just so you can see that what we have done there. This is for demonstration purposes only, so you don't need to do it. Just so you can see that it does all balance. So we have debited the receivables, haven't we? And we debited the receivables, was it with, sorry, debited the receivables, credited the receivables with the 6,400. We then debited payables with, was it the 3,400, and then we debited the bank. Is it there with the 3 million? And what you can see there is that your total debits are 6,400. Your credit is also 6,400. Okay. I think that's possibly the easiest way to do it. You could, if you want, split it out into adjusting for the cash in transit and then adjusting for, if you like, the remaining balances. So what you could have done if you wanted, you could say, let's debit the bank. Is it there with the 3,000? You could also then credit the receivables with the same 3,000. And then what that would mean is if you debited receivables with 3,000, there is then just 3,400 of a receivable left. So what you would then also do is you would debit payables with the 3,400, and then you would credit your receivables with the same 3,400. I'll just expand that a bit so you can see it. And what you've got, whether you look at what we've dealt with on the left, which is what we've done, if you look at what's been done on the right, you still end up with exactly the same adjustments overall. Okay, brilliant. Just to finish it all off, it's all about this deferred cash payment. Just one point to note, all of that I've put there, you don't need to put that within the exam. Okay, all you need to put within the exam, and I'll undo that just so that you can see and it's there so you can use it if you so wish. In the exam, you just need to put the adjustments on a line by line basis to each of, as we've seen there, payables, bank and receivables. Okay, excellent. There we go. So what you've got now is to finish off everything to do with this deferred cash. So what you've got, there's a further cash payment of $21 million, which is deferred until April X5. The acquisition date is April X4, so that's 1 year's time. So we know the future value at 21 million. We need to work out the present value of it in today. And we're going to use a cost of capital at 8%. And they've given us the appropriate discount factor using that discount rate of 8%. So here, what that is going to be is the 0.926 multiplied by the 21,000. And if you tap that in on your calculator, you should get, if I can find my notes, is it 19446? Okay, excellent. There we go. If you then total everything up, you should end up with, is it the 20446 for your goodwill? Okay, so get the easy bits first. So goodwill is there at 20446. Fantastic. And then you just need to be very, very careful, don't we? Okay. Oh, nasty little bit to go through there and finish things off with, because what you've done there is that you have recorded the present value of that item, that deferred cash. You then need to work it out at the reporting date. Okay, that is the challenge. Okay, so what you've got there is, well, do we need to work it out? It's effectively just that present value that we just worked out and increased by, is it the 8%? It's going to be, isn't it? No calculations required, Christopher. 21,000, isn't it? Okay, because we're preparing the statement of financial position at March X5. We're making the payment on 1st of April X5. So tomorrow we're paying 21 million. So the value of it is 21 million, isn't it? Okay. However, do just be very, 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 very careful. There's one little bit to consider, because we've unwound the discount, haven't we? So we've increased the present value to the 21 million. We've increased it from the 19,446. So within our group retained earnings, there's going to be some interest, and that interest is the 21,000 subtracting the present value of 19,446. So that interest that we have to charge, it goes to profit or loss, it goes to the group retained earnings. It's an adjustment in the parents' books of 1,554. Okay. If you then total up your group retained earnings, I think that comes to 290,950. You've got your NCI at 14,476. Goodwill at 24,446. Let's just fill in the blank. So trade payables, when you go through there and add it all across, that should give you 96,000. The non-controlling interest that we have is 14,476. The retained earnings is 290,950. Again, if you wanted to within the exam, you could look at what is attributable to the parent, and then if you like, your total equity is the combination of the 493 and the 14,000. Is that 507,926? No, 502,926. Again, let's just double check. Get on the calculator. It doesn't do any harm. 493,450 plus 14476 equals 507,926. It is a 7. There we go. Good job I checked, isn't it? There we go. 507,926. I could hear you all shouting at me, Chris, no, no, no. Let's complete things on the bottom of the SFP. Total equity and liabilities, 624,926. There we go. Excellent. What are the total assets? Couldn't care less, really. 624,926. If it doesn't tally up to 624,926, I certainly am not going to lose any sleep, because it doesn't matter if it balances or not. Okay. It would be nice if it did, but it doesn't matter. You get marked on a line-by-line basis. So if you get a bank figure of 7,300, you're going to get yourself a mark. If you get your receivables figure of 3,7,900, you're going to get yourself 1.5 marks. If you get the inventory of 3,7,280, you get yourself another mark. Goodwill of 2,0446 gets you 3 marks. The investment 12,500 gets you 1. And the PPE of 509,500 also gets you 1. Again, if you so wish, 542,446. That is the answer, isn't it, to the total non-current assets. And then your total assets are there at 624,926. Okay. Excellent. Everybody reasonably happy with that. Again, just a quick summary of what you've got on Part A. Remember the way in which we went through it on the property, plant and equipment. 100% of P, 100% of S. We then left it all, didn't we? Came back to it afterwards and added in the 10,000 fair value adjustment and then the 1 year's worth of depreciation. We depreciated the 10 million over the 10 years. The investment was at 55,000, so we put that in, didn't we? And then we deducted the investment that the parents had in the subsidiary. The only investment the parents had made and recorded was that of the cash payment of 42.5 million. As there were no entries for the deferred cash payment, then we didn't need to make any adjustment to the investment in this instance here. The goodwill we got from our workings, which we worked through step by step. Inventory, remember, 100% of P, 100% of S, and don't forget to deduct the provision for unrealised profit. Doesn't matter about the direction of sale, it will always be adjusted within the group from the inventory. Receivables, 100% of P, 100% of S. Don't forget to deduct, was it the remaining intracompany receivable and the cash in transit. And then the bank, 100% of P, 100% of S, and we added on the cash in transit. Equity, easy mark. Well, I say easy mark. It was probably an easy half mark of 202,500 being 100% of the parent share capital only. I should say equity shares. Retained earnings, your group retained earnings working. NCI, non-controlling interest working. Current liabilities, you've got your payables, 100% of P, 100% of S. Remember, we then just left that, didn't we? Before we then reduced that payable by the intracompany amount of 3.4 million. And then that deferred consideration, the amount that is payable on the 1st of April X4, year end March X5, payable on April X5, year end March X5, so it's due tomorrow. So the value is the 21 million. Okay. Net assets, I think the tricky bit within there is the PUP adjustment, because it was the subsidiary jogger that sold to the parent runner. So that 720 that you calculated goes within the year-end column of the net assets working. It doesn't go in the group retained earnings, which is where it would do if the parent runner had sold to the subsidiary jogger. Okay. Again, easy marks on the goodwill with a cash investment, the NCI, because they were given. I have to say the net assets is straightforward as well, because all you had to do was deal with the 10 million fair value adjustment. Nothing much there. Here, NCI acquisition given. Key bit here when you look at the NCI share of the post acquisition is to use your own figure. So even if you haven't got 7380, provided that you're taking your figure that you've got within your net assets working here, you will get the continuity marks. And then group retained earnings, the easy mark that we got at the start, 100% of the parent, 80% of your own figure, and then the really hard interest mark. So we recorded the present value of the deferred consideration at 19,446. It's going to get unwound to 21 million. The difference is the interest. If you want the journal entries, it's your debit to an interest. So debiting group retained earnings, crediting that deferred consideration to take it from 19,446 to the 21 million. Put in the working for your provision for unrealised profit. Remember to base it on the gross margin of 15%. So your profit is 15% of your sales. Here, it's not the total sales, it's the amount of inventory that's left at the end of the year. And here we were told it was 4.8 million. That's where we got the 720. There's a little bit there about the debits and credits that, remember, you don't need to record within the exam. But I think the key learning points that you've taken overall from these two videos is to do the easier bits first. So get part B done first. Get the easier bits done in part A. And this is the type of question where, one, you should not be failing, and two, you should be scoring pretty well, even if you're ignoring some of the challenging aspects of the question. Other than that, I hope you understand it. I hope you're happy with what we've done. If you've got any questions, post them on the Ask the Tutor forum. Otherwise, take care, and I'll see you all next time. Bye for now.